Welcome to Factful Finance, where we dig deep into the truth behind your finances, uncovering what the experts don't always say. In today's eye-opening episode, we're revealing how care home costs can literally swallow your equity, leaving you with less than you bargained for. Imagine this. You've spent years building up equity in your home, a lifelong asset meant to secure your future. But suddenly, that very asset could be drained away as you face rising care home fees. Sounds scary? Well, it's a reality many homeowners are facing, and today we'll break down exactly how it happens and what you can do to protect yourself. Let's dive in. The costly reality of care home fees. It's no secret that the cost of care homes in the UK has skyrocketed. According to recent reports, the average annual cost of residential care can exceed £30,000. For those who need nursing care, it's even worse, around £45,000 per year or more. And with a growing ageing population, these costs are only expected to increase. Now, let's get into the meat of the issue. Home equity release. Many people facing these high costs may turn to equity release as a potential solution. It might seem like an easy fix, accessing the value locked in your home to fund long-term care. However, what most people don't realise is that by doing so, they're potentially putting their home at risk of being completely swallowed up by care home fees. How equity release works and why it's riskier than you think. Equity release schemes allow homeowners aged 55 and over to unlock the equity in their property without needing to move out. Essentially, this means taking out a loan against the value of the property, which you don't need to repay until you move into long-term care or pass away. The most common form of equity release is a lifetime mortgage, which compounds interest year after year. At first glance, it sounds like a simple way to secure the funds you need to cover care home costs. But here's the issue. As interest accumulates, the debt grows exponentially. If you're not careful, the amount you owe on the loan could exceed the value of your home in just a few years, particularly if you're in long-term care for a prolonged period. Real-world example. Liam's story. Take Liam, for example. Liam is 68 and his home is worth £350,000. He's faced with mounting care costs, so he opts for a lifetime mortgage to release £100,000 to cover his expenses. Initially, this seems like a reasonable choice, but by the time Liam reaches 80, the interest on his loan has compounded so much that his debt has ballooned to £180,000. Now, his home, once his biggest asset, could be at risk of being sold to pay off the loan. What's worse is that because lifetime mortgages are often rolled up interest loans, the debt can quickly outgrow the value of the home. If the debt reaches beyond the property's worth, there's a real risk of losing your home and leaving nothing for your heirs. One of the key issues with equity release is that it can dramatically reduce the amount of inheritance you leave behind for your loved ones. Most people take out equity release thinking they'll be able to enjoy the funds for a few years of comfort, but when those interest payments accumulate, the long-term effect is a diminishing estate. Equity release also doesn't address the escalating care costs that often accompany long-term care. As fees rise, so does the debt. Before you know it, the home you thought would provide financial security in your later years could be gone, consumed by years of care home fees. What you can do to protect your home and your future. So, what are your options? It's essential to plan ahead. Equity release isn't the only route to take when facing care home costs. Consider these alternatives. 1. Long-term care insurance. If you're in your early 50s, now is the time to think about long-term care insurance. This can help cover care fees without the risk of eroding your home equity. 2. Downsizing. While it may not be the most attractive option, selling your current home and moving to a smaller, more affordable one could release the cash needed to fund your care while preserving your equity. 3. Care funding advice. Speak to a financial advisor who specialises in care home funding. They can provide guidance on how to manage your assets without risking your home or your inheritance. 4. Government assistance. Depending on your financial situation, you may qualify for financial support for care fees from the government. Investigating these options early could save you thousands. Disclaimer: This content is for educational purposes only. Mentioning any apps, products, or services is not an endorsement. Always consult a certified financial professional for personalized guidance. The bottom line: equity release may seem like a lifeline when facing the mounting costs of care home fees, but it comes with significant risks that could leave you with far less than you expected. Whether you're considering equity release or looking for alternative ways to manage your assets in retirement, understanding the full implications is crucial. Don't let care home fees consume everything you've worked for. Which aspect of care home costs concerns you most? Drop your thoughts in the comments. I'd love to hear from you. And if you found this video insightful, make sure to subscribe and hit the bell so you'll be notified when the next episode in this critical series drops. Trust me, you don't want to miss what we have lined up next. Want to dive deeper into how to manage your assets effectively in retirement? Click the video on screen now.